This week, Will Lin from Forgepoint Capital is with us to discuss security market trends. Then James Norrie from CyberCon IQ joins us to talk about addressing the human element in security. Finally, in the enterprise security news, SentinelOne and Crowdstrike reinvest in the security market. Malwarebytes raises $100 million. Ox Security raises a $34 million seed round. Jamf acquires ZecOps. New startups looking to improve code reviews, outsourcing questionnaires, and providing consumer privacy awareness. Federal security funding for state and local governments. New software supply chain attacks. Microsoft Windows slaps your hand when you try to update passwords.txt. And stick around until the end when we talk about a New Jersey deli with a $100 million market cap. All that and more on this episode of Enterprise Security Weekly.
This is Security Weekly, for security professionals, by security professionals. Broadcasting live from G-Unit Studios in Rhode Island, it's the show where we talk security vendors and aren't afraid to name names. It's Enterprise Security Weekly.
Don't leave the door open. Secure your APIs with the Curity Identity Server. Curity allows you to centralize identity management policies with a solution developed by an expert team using well-established standards. Curity facilitates scalable security for apps and websites by offering a unique combination of identity and access management with API security. Protect your users, secure apps and websites, manage API access. Start your free trial today at securityweekly.com/Curity. Companies big and small are using AwareGo's human risk assessment to measure the human risk factor in cybersecurity. This interactive solution allows companies to measure employees' knowledge and behavior across threat vectors such as phishing, passwords, sensitive data, and more. After completing the assessment, CISOs can identify vulnerable departments and roles and improve internal policies or procedures. Visit securityweekly.com/AwareGo to start your free trial. Managing and protecting the world's grueling number of endpoints, enabling Tanium's customers to see, control, and protect every endpoint everywhere. Tanium's mission is to provide certainty in uncertain times with the industry's only converged endpoint management. Trusted by the U.S. military and the majority of the Fortune 100, Tanium helps manage and protect nearly 30 million endpoints. Tanium, the power of certainty. Visit securityweekly.com/Tanium to learn more. Welcome to Enterprise Security Weekly and happy National Coffee Day. This is episode 290, recorded on Thursday, September 29th, 2022. I'm your host, Adrian Sanabria, and joining me today is the Czar of Zero Trust, the captain of content, Katie Teitler. How are you, Katie?
I'm well. I could use another cup of coffee. How do you take your coffee, Adrian?
Black.
Like your soul. Sorry, I couldn't resist.
I'm a simple guy when it comes to drip coffee, I guess. But I also do espresso and espresso drinks.
No pumpkin latte for you?
Plain latte if I do a latte. Yeah, I don't get crazy with it.
Alas.
Also joining me is the herald of hacking, the captain of crypto, Mr. Tyler Robinson. How are you, Tyler?
I am fantastic. I think National Coffee Day is kind of redundant. That's pretty much every day for most people. In fact,
that is true.
Today would be different if I put another coffee inside of my other coffee with a shot of coffee. That may be National Coffee Day.
That's like there's different names for that. Shot
in the dark.
A red eye. Yeah. You can get coffee inside your coffee. That is a thing. Finally, we have a third co-host with us today, Sean Metcalf. How are you, Sean?
Hi, Adrian. Doing well. Thank you. And yourself?
Yeah, pretty good. I apologize. You're a bit of a late addition, so I don't have a fancy intro for you yet. I have to get to know you better to come up with a fancy intro.
Fair enough. You always have to earn a title, right?
Right. All right. Quick announcement here. Don't forget to check out our library of on-demand webcasts and technical trainings at securityweekly.com/on-demand. And we are going to jump right into our first interview. Today, we're excited to have Will Lin with us again. to discuss the market, the security market. Always fun to have these segments, to have a VC on here, get that perspective. And Will Lin is the managing director, co-founder of Forgepoint Capital. And welcome, Will. How are you doing?
Hey. Yeah, always have fun seeing you guys. Thanks for the invite.
Coffee opinions? How do you feel about coffee, Will?
I love that coffee is 0 calories, so black for sure. But I love even more a well-made espresso. A lot of work.
Yeah. It's I can really geek out about coffee, but the way I make it is about as simple as you can get. Just use an AeroPress and a hand grinder.
Classic.
Beans and water. Beans and water. Indeed. So Will, the last time we had you on, I actually looked it up. It was 20 episodes ago, episode 270. We were asking about these huge valuations we were seeing that just, seemed almost mind-boggling, like maybe didn't fit the market. And we were asking about potential market resets and corrections. So a little hindsight here, it seems like maybe we were onto something that episode.
Yeah. We definitely called the future a little bit for that one. What goes up must come down kind of dynamic, right?
And it's interesting because we actually did report on layoffs a while. We saw a little over 1,000 layoffs, and something like 95% of those were OneTrust, which had a huge layoff and was responsible for most of those. But for the most part, we didn't see anybody shut down. We saw maybe some resets on how much their next raise is going to be or when their next raise is going to be, but ultimately, it didn't seem to be that disruptive to the security market. Do you agree?
The layoffs definitely not as disruptive. Like for instance, I'm waiting for people to start saying, hey, all these layoffs happen and they're having a really tough time finding their next job. I haven't gotten that data yet. And in fact, when I looked, in just general news, people are still talking about how unemployment is still at record lows. And so we'll see if that ever happens in terms of the layoffs leading to higher unemployment, especially within security. I think it will happen. It's just a matter of time kind of dynamic. But right now, I think the market's still looking good, especially for folks who are sort of mid-level and junior level.
Now, the VCs are definitely filling the love with this kind of reorganization and bringing back the market to reasonable levels. The ability for you guys to have a lot of buying power with the restructuring of that and getting a better deal on companies, and actually it's probably better for the companies long term. Why is that usually a better time for VCs to buy, and why do companies often get a better deal because of the lower valuation?
Yeah. So, one thing that just generally tends to happen is venture does follow the public markets, especially when it's going up really quickly. So let's say, tomorrow the valuation is 90x revenue. Rounds being raised pretty soon right after that. We'll be talking about 90x revenue, and they'll be extrapolating how that 90x in the public markets should be interpreted in the private markets. When the markets are going down, though, it's actually very different. Most people like waiting for the markets to settle out a little bit before they start making that next big decision in venture. And so what's happening right now is, yes, I agree with you. There are better deals for the investors right now, mainly because, yes, the valuations are down. But the other reason is because those companies, for whatever reason, have to raise money. And as a result, there is just more reasonableness on both sides in terms of finding something that feels like a better valuation, especially for the VC. There's still some rounds, though, that are being announced now that were raised back in April, May, June timeframe, for example. And so back then, yes, there was a little bit of a correction, but still some 2021-esque deals were happening. So we should be mindful of that. But I think by the end of this year, most of the announcements will all be in the mindset of, for whatever reason, that company had to raise money. And either it was an investor who wanted to go along with them and was willing to do something more reasonable valuation-wise, but not a huge discount, or maybe even a flat round. And then in some cases where everyone had to get comfortable and accept a down round as well.
Does that also help with the bringing about a much clearer understanding and weeding out a lot of the kind of smoke and mirrors that many of these startups are bringing, where they don't really have a fully well thought out product, or the service and product that they're bringing, is a lot of back end UX and UI, again, smoke and mirrors, so that they can get that valuation for that first seed round or maybe Series A. Is this helping kind of clear up some of that and provide true value to companies looking, as well as the VCs, and really identifying what they're getting from what's being presented?
It is. It is definitely contributing to that getting fixed. And in fact, it's a little bit compounding as well, right? Because of the market correction, it's also impacting budgets a little bit in terms of more customers are being more hesitant to pull the trigger on new companies. And so as a result, even the smoke and mirrors companies, they're having an even harder time generating revenue. And at the same time, VCs are looking for more data now, more validation that this product actually works and is important at the same time. So a lot of different things are coming together where I do think that it's making it harder for the smoke and mirror companies to exist and to have they're having a tougher time.
Does that follow the M&As as well? Like the mergers and acquisitions piece of this is a lot of this market trending in the exact same way for the M&As?
It is. I mean, in general, most people don't want, like, if you have an option to not do anything, whether it's funding or M&A in this market, you probably won't, right? I mean, there's so much uncertainty, so many people, you're sort of waiting for the new normal as a result. And so because of that, that's going to weigh down on M&A side as well in terms of valuations, because the companies that are selling now, for whatever reason, it's there's either a really, really good reason that they need to sell now or want to sell now. Maybe it's acquirer driven, or there's a really, really bad reason where it's company driven and they need to sell now.
So piggybacking on Tyler's question about the smoke and mirror, so to speak, my question is around companies that have been promoting AI, artificial intelligence. And certainly there's been a lot of buzzwords around information security and security companies that have products that are looking at things, and they a lot of times say that AI or artificial intelligence is behind that. And we've seen a bigger trend certainly recently around blockchain as an offshoot of crypto and Bitcoin. How do you see VCs really kind of cutting through that and identifying which ones are actually using an AI, or if there is secret sauce there that really is valuable that can contribute to that bottom line for a VC as an investment?
Yeah, the listing product is one where there's lots of different strategies on how to do it. You can sort of diligence it yourself. You can go deep into the technology. You can go deep in terms of looking at the demo. You can go deep in terms of hiring someone to go look at the architecture of the solution, for example. You can hire someone to go deep into looking at the talent on the engineering team. I think the most common one, and the one that's most repeatable, is to look at how the customers are viewing the AI/ML within a startup. If the customers are saying, hey, this works, the results are good, it's useful, it doesn't require a ton of tuning, and I trust it, that is a really good sign that what is going on there can be translated to other future customers. I think one of the dynamics to startups that I think, and this happens in consumer as well, is that sometimes in the very, very early stages, they might not have true AI or true ML, or they might be using it, but at a smaller, not 100% leveraging it, for example. And so in consumer and in enterprise, there's this, and in product management, there's this phrase called like man behind the curtain, where they actually have people really doing the work. And so, yes, it is sort of AI because there are intelligent people in the background doing the work as well. And I think that's something that we should be mindful of as well. It's like we should accept that maybe for some scenarios, it makes sense to have this quote unquote AI ML, but it's more human assisted AI ML. And then over time, tune it until it's one day 100% automated. And so one consumer example that a lot of us will know is a company, Stitch Fix. Initially, they had designers picking out all the clothes for people, and then they had AI doing only recommending a portion of it. And by the time they got to IPO on a large scale, at some point, it was predominantly AI choosing the Stitch Fix boxes for every consumer. That type of dynamic is definitely happening, and it should happen within cybersecurity as well.
So in terms of, sussing out the market with VCs and startups, where the VCs get to be a little more choosy about the startups they invest in, or even the larger companies they invest in, but in terms of the startups, and it's shaking out a little bit for VCs, how does that translate to the market? Does that potentially discourage some startups if they don't think they have a strong enough product? How does that influence the market, impact the market in terms of the consumer? Do they not get to see so many options? And is any of that bad if there is this trickle-down effect?
Yeah. So it is, I think one of the fun things about when we look at economies, it is really an ecosystem, right? It requires a buyer and a seller. It requires multiple different people to be involved. And so, the reality is that because investors are really uncomfortable right now in terms of making big bets, for example, though what that means is that entrepreneurs are very hesitant to raise money right now as well. And so both sides are sort of not doing a ton right now. Acquirers, though, are actually active. And we're seeing acquirers be very proactive right now in terms of diligence in companies, seeking out companies to acquire, because for them, when the market, with the market correction, they have a very reasonable and healthy way of talking to a company that either has been doing really well or not doing so well, and say, hey, this is where the market valuation is now. Do you want to keep going for another 3, 5, 10 years? Or do you want to sell now and celebrate all the successes that you've had so far? So that's where I will see a decent amount of innovation starting to flow into, is I do think that we'll start seeing it within big companies as well. Now, with regards to customers' access to innovation, I also think at the same time, right, customers are also being more conservative in terms of purchasing solutions as well. And so as a result, it is also making it a little bit more difficult for the startups and even the large companies to be able to predict what the end of the year will look like. We just finished Q3. We still have a whole nother quarter to go. And right now I'm very optimistic about Q4. So we'll see.
Somewhere there's a sales team saying, no, there's 1 day left. There's still 1 day.
I was thinking that the old salesperson to me was like, wait, they have till the end of the day tomorrow.
Yeah, you just freak some people out, Will. Listen to this. So quick question, again, on the market correction, is this, are you seeing more diligence from VCs, not necessarily due diligence, but expectation of some more solid revenue metrics in earlier stages? I mean, generally, like expecting market fit at Series A is probably not a thing. You're going to be a little bit looser with some of those metrics, but maybe by Series B. And I guess another way to ask this question is, are $5 million ARR unicorns a thing of the past now?
Definitely a thing of the past. The $5 million unicorns, not ARR unicorns. So it's really tough to say. Like, I think I have to extrapolate. And the reason why I have to extrapolate is because right now, very few investments are actually happening. And so as a result, it's really hard to say, hey, what's happening now when there isn't a lot of investing. But if we were to extrapolate based off of experience and what was likely to happen, what's likely to happen is that the revenue targets will become more firm, more set, more clear. So, for instance, Series A, something around $1 million or some visibility to $1 million. Series B, something around 3 to 5. Series C, something more than that kind of thing. And in the past, talking about the $5 million AR unicorns, those were, people applying Series B metrics to Series C rounds and Series A metrics to Series B rounds, because there was just so much confidence in that company hitting those next rounds metrics anyway. So why don't we just invest now? Like, sort of thinking a little bit of like, it's like shift left, but investing kind of dynamic. And so that's going to be one dynamic. I think the metrics that a company needs to hit per series will become clear, or more firm. I think valuations will become a little bit more firm as well. And then finally, I think that investors will have more opportunity to diligence deals. Like in the past, investors, because there's so much competition, had to move super, super fast. And as a result, they had to prioritize how much diligence they could do. Now I think we'll have a little bit more time. So we'll still have to prioritize, but we'll get a lot more diligence done than before.
What's the temperature of the market, especially among startup CEOs who launched their companies sort of during the boom period, who were expecting really high valuations? Are they remaining optimistic? Are they adjusting their attitudes, ideas, expectations? Or, has this just not changed at all?
So the reality is that a lot of CEOs have had to do the layoffs, right? And I think even if they didn't do a layoff in their own company, they recognize that other companies have. And so I do think that is weighing on a lot of them in terms of what they think about the future. The key word right now is efficient growth. Before it was growth at all costs. Now it's efficient.
I was going to say, does the formula now change for a lot of how the VCs are looking at things? Do you have to restructure your entire formula to kind of identify those companies that are going to be a strategic investment, and how long until that either payout or Series A, Series B? Does that formula end up changing, or do just the numbers end up changing?
Yeah. I think primarily the numbers are changing. I don't think that right now people are thinking about, oh yeah, because the markets are better now, I'm going to make 5x. While before I was underwriting to a 3x, that kind of thing. It's just so hard to predict the future in terms of where the valuations will be when these companies move towards an exit. I think where the industry rests on is that when companies do really well, they do really, really well. Like, it doesn't matter if it's a 3x or a 5x. It's going to be something that will be materially shape the direction of the fund that company is invested in. And so that's sort of a little bit sort of the continuing mindset within venture, especially early stage. I think if you move to later stage, those folks are much more aligned to what the public markets are doing. And so those folks are looking very, very closely at the valuation of each company in the public markets. So like, oh, interesting. Varonis's valuation hasn't dropped as much as Okta's valuation, for example. And so that sort of that kind of segmentation of the data of what's going on in the public markets is what the later stage investors are spending a lot of time doing.
What are some of the
drops?
advice that you can provide today's kind of startups or founders if they're looking to get their seed round or going into a Series A? Like, what is some of the advice from the VC side that you would offer them?
Yeah. I think the efficient growth theme is the best theme, and so anything you can do to sort of demonstrate your ability to grow efficiently for a long period of time would be great. And so what that means is it's one where you're balancing both revenue and expenses. And so my advice is that I've seen some companies grow incredibly efficiently. It doesn't always require costs to grow, and it doesn't always require spending to grow. There are so many high ROI places to focus on. I think when we're spending more, what's happening is like I'm imagining a curve, right? And all the initial things that you spend on are super duper efficient. Let's say you're getting 10x ROI, the initial things that you spend on, like the low hanging fruit, for example. But because you're spending, you can start tapping into the middle hanging fruit. And then when we were in the growth at all costs, it was like, I don't care about low hanging fruit. I want everything. Give me all the fruit on that freaking tree ASAP, that kind of thing. And so even though it was expensive and difficult to get the fruit on the very top, you still went and got it because it was worth it, because everyone wanted that fruit. And so as a result, I think there is value in saying, hey, maybe we should just focus on the highest ROI things that we can do. And that's going to drive the efficient growth that we're looking for. And that's going to give the investors clarity in terms of the entrepreneur's ability to grow a business in all different sort of funding environments, whether it is an efficient growth market, whether it is a growth at all costs market, or potentially we go even further down where it's like, hey, I only care about cash flow. And then, seeing a company that's able to sort of build their business with a cash flow in mind, I think will be the next sort of, if the market continues to go downwards, will be the skill that investors are going to start looking for.
Will, I just wanted to check if you still had a few more minutes. We still had a few more questions, but I know you might need to go.
No, we can keep going. All good.
Okay, cool. So a quick question here, and I think Katie has another one. Are the investors, are you noticing any big changes in who the investing community is? I know we have a couple stories today about CrowdStrike and SentinelOne that have raised their own funds, their own strategic funds for investing. And then, something I never know if it's just a pattern I've just now caught on to, or if it's an actual new pattern, is why I have to ask you. But, I've noticed syndicates are very much a thing. I've seen a lot of people pulling together syndicates, which seem to be groups of, I guess you could call them angel investors, that tend to be active in Series A or seed round or even pre-seed.
Yeah. So, I think it's always fun because the corporate investors do move in and out of the market. And, in my mind, I'm actually really enjoying seeing sort of the SentinelOnes and the CrowdStrikes being more involved on the investing side, because I do think there is a lot of opportunity right now to be as an investor, especially when you have the reputation that you do have as a leader in your respective markets. I think it's a really great way to expand the aperture of what the company does, as well as find win-win scenarios as well. I think part of the reason why there is more interest in talking about the corporate VCs is because, the financial VCs are super hesitant right now to make investments, and so that's created the room for new corporate ventures to come into come into play. Yeah, and the syndicates, that's a whole another fun topic. Where do you want to start on that front?
Yeah, I guess part of what I was wondering is this a new thing or just something I'd never noticed before that, now I'm suddenly aware of? It's kind of like, I don't know, you learn something about a particular new car, and then that's all you see on the road just because your brain is now trained to look for that thing. So, part of it was just a sanity check. Like, are you actually seeing some changes in the market here? Are syndicates a fairly nascent thing, or have they been around for a while?
Yeah. So the syndicate thing is, in terms of popularity, has definitely come up more. I would say probably starting, especially within cyber, I think probably starting 3 years ago. Have there always been syndicates? There have been. But in the past, they were more like founders investing in other founders kind of syndicates. And they were sort of more private kind of things. Like you'd see the name of a syndicate and it would be something like Silicon Valley, blah, 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 blah. In the past 3 years, I think that more folks have experimented with having customer created syndicates. And then they've also experimented with marketing that those customer based syndicates and all the things that customers can do for the companies that they invest in. And I think there's also been sort of syndicates that have been sort of brought together, whether they're investors or not, by VCs as well. So, for instance, we have an advisory council at Forgepoint of entrepreneurs, customers, and founders. I think what's been the most experimentation so far, and that's why you're seeing a lot more now, is the marketing. That part is new. And then the customers investing in the products that they could become customers of, that is decently new as well.
So just a quick question about this idea of efficient growth. In the past few years, a lot of companies have tried to attract talent by talking about the hypergrowth and how much opportunity there would be if a company were acquired, if it would IPO. So does this change from hypergrowth to efficient growth change how companies have to recruit? Does it change the type of talent they can attract?
Yeah, so sometimes like it's always fun to, like, for instance, I'm in Silicon Valley coffee shop, for example, you can sort of, the conversations, there's a lot of similarity sometimes to the conversations. And, when a market corrects, a very common conversation that you'll hear tech folks talk about is how their options are underwater. Yeah. And that naturally drives them to realize, oh my God, like, it's nice to have these options and I fought for them and whatever, but it's underwater. They're useless. They're worth nothing. And so then it starts getting to a mindset of, okay, well, now I want to join a company that's fundamentally a stable business, a quality business where those options will not only never go underwater, but also increase in value as well. And so that's when the conversation around efficient growth will come up more. And then if the market keeps going downwards, there's more and more people, there's more layoffs, the unemployment rate is a lot higher, almost everyone's options is underwater, then that's when people are going to start thinking about, okay, well, let's not spend too much time thinking about options. Let's spend more time making sure the company that's employing me has the cash and the long runway and a good environment and a lot of work and a lot of learnings I can do so that I can have a stable job that's paying me well. And I'll look at those options as well, but I view them as like a nice bonus on top of my cash bonus kind of dynamic. So how will recruiting change? It will change on both sides. It's already beginning to change on the talent side as well, because more and more talent They either suspect that their options are underwater, and then even worse, some talents knows their options are underwater, and so now they're just trying to think, okay, what do I do now? Do I decide to move on because I don't, because I really value the value of these options? Do I decide to ask for new options because my current options are underwater? I think a lot of folks who don't know yet that their options are underwater or suspect it, or even if they know, I think a lot of people are trying to decide how much the options care to them or how much they care about their options.
So does that shift the balance perhaps to bigger companies who've been around a while, and put some startups at a disadvantage? Because that's one of the things that startups can leverage when they're trying to attract top talent, but they don't have the name, they don't have the reach. It's the opportunity. So when the market shifts and naturally employees are looking for more stability, more comfort, does that put startups at a disadvantage?
It does. But I think the reality is startups have always, or has recently, been at a big disadvantage because there's been so much competition for talent that it's actually been a common one, where you see a startup paying more than a big company for the same talent. Not more just in terms of when you look at equity, but pay more in terms of cash when you compare it versus a big company. And with the whole efficient growth dynamic that's changing, I think that luxury is no longer realistic or possible. I still remember when people were saying, "Oh yeah, I'm like one tick below Google, or I'm 2 ticks below Google," whatever you define those ticks to be, whether it's 10K, 30K, 60K. But I'm, one rung below it. And then in the, very aggressive market, growth at all costs market, people were regularly 30K more than, for instance, than Google or Facebook or Netflix. And so, to your point, I do think it will drive talent back to the big companies, because startups will again have to pay less than a large company in terms of cash, and then the options will be very difficult to quantify as well in terms of saying how valuable it is. And so you see the stability, you see the certainty, of when you're working with a big company as well. And so as a result, I think we'll see a lot of A players start moving back to big companies as a result.
And speaking of efficiency, we have some questions in the live chat here. A great one from an appropriately named listener, Darwinism, asking about the strength of the dollar against some other foreign currencies at this point. Is that leading to interest in deals overseas due to that? Kind of the I guess the euro, the British pound. A lot of currencies are a bit weak compared to the dollar right now.
It's funny. When the markets are doing well, people expand outside of Silicon Valley, for example, or wherever they're based. And when the markets are doing poorly, people usually start coming back to what used to be doing before. And so I still remember a time when folks were very proud that they only invested in Silicon Valley, for example, never went outside of it. And then as the competition heated up, that sort of forced everyone to start looking outside Silicon Valley, outside the big hubs. We're looking internationally. And so the correction environment is actually going the opposite effect. I think it's a really great point in terms of looking at the strong dollar versus other currencies. I think where that's really being leveraged is more on the talent side. I could definitely see more startups working harder to hire talent internationally versus in the US, especially because it's going to take a little time for the salaries, which I mentioned before were higher than Google or Facebook, to go to the same level as Google or Facebook, to finally below the cost of Google and Facebook salary. And so one way to short circuit that would be to go international.
And before we wrap here, I wanted to ask you if you've learned anything interesting as you've explored different internet options, both at home and with your mobile devices. Trying to find the best internet as you travel around the world and in the U.S. I know you've been experimenting with that a lot.
Yeah, of course. I love talking about that one. So, I recently discovered the whole dual SIM sort of joys, and I started exploring doing bench testing T-Mobile versus AT&T, for example. I was recently in Tel Aviv for a week, so I was bench testing those two as well as local ISPs or mobile internet providers. I do think, and this is actually a fresh thought that I'm still working on in my head, but I do think that we should start thinking about cellular networks as the way that we thought about home networks or corporate networks. I think the ability to create a private cellular network now has gotten so much easier than it has been in the past, that I can sort of see the things that we used to do in terms of creating a perimeter around our enterprise networks happening on the cellular side. And I can start seeing more of our corporate devices all each having a cellular connection, and then us managing the network or the data or the management, the MDM side of each of those devices via the cellular connection instead of on the device itself. So, and I think that's going to move from like the super fancy, like, oh, Amazon has their own, private cellular network for their warehouses, to, a startup one day saying, hey, all 10 employees are on this startup's own cellular network, and via that, getting access to the different corporate resources.
Yeah, I know. I absolutely love a Lenovo X1 I have. It did not have cellular antennas when I bought it, but I actually went onto Alibaba and found the kit that I needed to add it retroactively to it. And I've been having a hard time finding a replacement. It's really hard to find a laptop that'll take a SIM card, that has 4G or 5G capabilities. And typically, you have to buy the most expensive model. Like, it has to have 64 gigs of RAM and, the high res touchscreen and all that. But I wish that was a more standard thing. It is in iPads, but laptops, like a MacBook, has never come with built-in cellular technology, for example. So yeah, I'm with you. I would love to see that in more devices.
Yeah, I actually think we'll see. This is, sometimes you make these guesses about what the future will look like, and sometimes you're like way too ahead of its time, and it's like what you said won't happen until 10 years later. For example, I actually think, I don't know, I'm hopeful that we will start seeing it as standard in the next 3 years. Maybe 5 years at the latest, but I think this is going to be a 3 to 5 year thing. So to your point, Adrian, I think we'll start seeing every device have cellular capabilities in the next 3 to 5 years.
I don't want to ask baristas for the Wi-Fi password anymore. I want that to be a pass.
Yeah.
Will, thank you so much for joining us today in Enterprise Security Weekly. It's been a blast.
Pleasure as always. Thank you. All
right, stay tuned. When we come back, we're going to talk securing the human element with James Norrie from CyberCon IQ.